But if the stress test is really used to give a realistic picture of the banks, I think that the good banks will be able to raise money, and that will narrow the problem. And then the government can deal with the recapitalization. And then we avoid the danger that I think we are all aware of zombie banks that deep in the hole that are going to have to earn their way out of that hole and will continue to weigh on the economy for a very long time.
George, thank you. Professor Wells. We have done this in alphabetical order, in case you hadn't noticed. I'm sure Robin has dealt with being a W for a long time.
Yes, and I have the advantage of then following up and being able to follow up on what others have said, so it's fine by me. I don't have any particular expertise about what the economy is going to do today or 6 months from now. I don't have any particular expertise on how viable the green shoots are, although I will say that I'm somewhat skeptical because, as I've said to other people, the rate at which things were declining during the first quarter means that if that decline kept on, pretty soon we'd hit the Stone Age. So it had to moderate at some point. However, moderating is not the same thing as a recovery. And as Paul and others have said, I'm not really sure where a recovery is going to come from. But given that, I also want to focus on a somewhat different point. I do think that for policy reasons, it's important to figure out whether there are green shoots and how viable they are. But I think that an emphasis exclusively on that leads us to the possibility of not solving some deep structural problems. What I'm really concerned about is what do we do to prevent ourselves from being in the situation 10 years from now? Say if we do have green shoots, say if we do start to have a recovery, say by this time in 2010 or maybe a little bit later, although I do think that's somewhat unrealistic, what prevents us from, if the banks have limped along and the stock market is back up, 10 years from now, having gone back into the situation of excessive leverage and having an implosion of the financial sector and these huge global repercussions. And in order to answer that question, or at least examine it, I have to take you through a little economics tonight and a little bit of history. I want to go back to what Paul said about the global savings glut. The global savings glut is what drove interest rates down to historically low levels. And if you know much about macroeconomics, you know that housing is very sensitive to the interest rate. And therefore, a housing bubble was practically foreordained with an extended period of low interest rates. All right. But you'll also notice that the bubble in housing hasn't been just in the United States. It's been in places like Spain. It's been in Eastern Europe. It's been in the UK. It's been in Ireland. It's been in Iceland. So Paul is really correct when we talk about a global savings glut that, yes, impacted us very badly, but it's impacted other countries as well. So I think in order to prevent us from re-experiencing this catastrophe in another, say, 10 years, we need to look at the origins of the global savings glut. And now, yes, there are some differences in how those were actually manifest between the different countries, and those manifestations are important, but let's look for a moment at the global savings glut on a global level. All right, so if we back up, and I think this story starts really about in the 80s, because in the 80s, during the Reagan years, we began to experience chronic fiscal deficits. And we began to abdicate our responsibility to raise tax revenue that could sustainably finance government. Now, in order to do that, we had to borrow. And who did we borrow from? We borrowed from countries that were running persistent trade surpluses. And going to Niall's point, that's China, that is also Germany, and that's also Japan. And as we continue to run these deficits, these countries, by keying on growing through exports, there grew to be this symbiotic relationship, as Niall says, this chimerica, but it was on several different fronts, between the net exporters, such as China, Japan, and Germany, and the net importers of capital, the largest, of course, being the United States. All right. This import of capital allowed us to consistently live beyond our means. First, through the fiscal deficits, not raising enough tax revenue to finance the government, and then also through, ultimately, the leverage that we used in housing and in commercial real estate and in leverage buyouts. And this continued, and it grew, because there was nothing anywhere along the line which anyone would say, halt. I think that we had a situation in which we were governed by an administration, Republican administrations, in which it was in their interest not to call a halt to these persistent imbalances. The persistent imbalances led us to pretend that we could keep borrowing and not having sufficient tax revenue to pay for the government. And also, if your house prices are rising, if your stock market is going up, which is, of course, is going to happen if you have cheap money, it puffs up the value of the assets, then that disguises a lot of other structural problems, such as rising inequality, all right, such as corruption. So at this, we also get an increase in the financial take of the economy. As we have this inflow of capital from abroad, the financial sector in the United States grows larger and larger relative to the rest of the economy. So we have what I call a financialization, where the GDP is tilted disproportionately towards the financial sector. All right? How do we start to get out of this? Well, it's difficult. All right? We have a situation which I find that we're in many ways almost adverse to bringing up the situation that we find, the codependent situation that we find ourselves in with the net exporting countries. I thought it was quite interesting a few weeks ago when the Chinese, many Chinese officials were saying that it was proper and it was good economically that the U.S. continue to run persistent trade imbalances with China, that the renminbi did not need to be appreciated, that we should continue doing the things as we always have, and that the U.S. should make sure that the value of Chinese assets were not diminished by a fall in the dollar. Okay. I thought that was very interesting because it really was a situation in which it was clear that this was not a sustainable relationship. But no one was willing to say that, and no one was willing to say that clearly in terms of the Chinese. So I think in order to get out of the situation that we're in, we're going to have to address these global imbalances. And I know it's easy for me to say that as I'm sitting here, I'm sure, in my Chinese-made silk blouse, but we're going to have to start to address these chronic trade imbalances. You might very well see a shift towards more protectionism. We're going to have to actually do something about raising taxes so that we can sustain government rather than depending upon borrowing abroad. I think that we're going to have to start stepping into our role, one that we abdicated, as true managers and guardians in the global economy, and that we're going to have to start to grow up globally and economically.
Niall, why don't you respond to the comments, and then we'll have a little discussion on that. And then I'd very much like to move to the longer term that Robin was introducing and how we really organize the American economy in the future. But let's take it from here.
Well, if you listened carefully to what Paul Krugman said, he actually agreed with me. because what he said was that if